Hello and welcome to another Wealth of Advice market update on the 15th of March 2021. So quite a lot's happened since the last time we recorded an update, and many people now feel that we are starting to eventually move on from COVID. The Brexit deal has been done and it's now behind us. The vaccine rollout continues to be a success. Certainly in the UK. Also read over the weekend that in the US, Biden has delivered on his promise that he would have 100 million Americans vaccinated within the first 100 days of his presidency. Well, he's managed to do that with only 50 days of his presidency now passed. Hospital inpatients in the UK with COVID is coming right down. The number of deaths is also falling. So there's definite reasons to be cheerful. So why are markets and fund values falling? Well, one of the reasons, which might be attributed to the volatility in some market falls over the last few weeks, has got to be the fact that our trades that we've been doing with the EU obviously went down during the month of January. A lot of people said this was to be expected, and as you can see, imports and exports actually increased towards the end of 2020, I'm guessing in anticipation of what people were expecting a Brexit no deal maybe to happen. So the fall in January, a lot of experts are saying this is just going to be a temporary measure and things should pick up again as the year progresses. Another concern for markets was how much the UK economy shrank during the month of January. It was minus 2.9 after we saw some great bounce back following those huge red falls that you can see March and April of 2020. Obviously, the Prime Minister announced the third lockdown at the beginning of January, so it was to be totally expected that we were to see this minus figure during the month of January, and we would expect that when the figures come out for February, March, and definitely April, once some businesses are able to reopen, and that you will see a good bounce back from that. Perhaps the main reason for the market volatility and the falls that people may have seen since January is the performance of the fixed interest parts of your portfolio. So fixed interest securities are the lowest risk part of your portfolio. In its purest form, if you hold a fixed interest security up until the fixed interest security is redeemed by the government, that's a form of a gilt or a corporate bond. If it's issued by a company, you will always get back the amount that you've invested into it because it will be redeemed at a date in the future. So government gilts, for instance, are no risk assets in a sense. However, they are traded, and when they are traded, they can be traded at a discount. And the returns that you've seen on these risk-free assets since January has been anything but risk-free. They've gone down. So during 2020, when inflation and interest rates remained low, this also caused bond prices to rise. So last year was definitely a good period for bonds. Since January, we mentioned this on our last update, obviously inflation and the threat of inflation is coming back, and there has also been a hint that there might be rising interest rates maybe in the US. Well, when we say interest rates, we mean long-term expectation. So markets believe that inflation will increase in the future, and as a result, this is called bond prices to fall, and there has been a sell-off in bond prices and bond yields. And there's been a lot of movement away from sort of risk-free assets, maybe into riskier assets. So as you can see from this graph here, bond market returns from the start of 2021 have been largely negative. And as I said, these are supposedly risk-free investments. So UK gilts, for instance, of that 2.5 month period from the beginning of the year, down minus 6%. So inflation data released on the 10th of March in the US started to ease the worries about rising prices. We fully expect these risk-free assets or the low-risk assets to continue to perform well in the rest of the year, and we think this short-term volatility is now kind of behind us. It'll be interesting to see what the US job figures are like in the coming weeks when they're released. And Janus Henderson, who we have a lot of faith in as one of the bond fund management companies who we use, they believe much of the news recently about inflation returning is more hype than reality. Inflation figures released during March and April will they will be artificially high because things have been rising as people get out spending again, but they expect these to fall back. Oil price is definitely a good thing to look at when we consider inflation. And oil price fell dramatically during 2020. Obviously, people weren't taking holidays, weren't going out in the car as much. We can sort of see and feel all that. But within business as well, a lot of oil demand just fell off a cliff. So when the oil prices are seen in the next couple of months, they will look substantially higher year on year. This doesn't mean that oil is more expensive than it was pre-COVID. It just means that the price has corrected itself. Jupiter, another fund manager who we use, they continue to believe that inflation and interest rates will remain low for the long term due to the following trends. Aging demographics. There is all over the world, people are living longer and getting older. But as we get older, we do spend less in our later years. The low cost of labour. So because unemployment has been so high, it's not costing companies that much to find and attract new employees, so wages won't be going up very much at all. So on the back of that, you can understand why inflation won't be really high. However, as we mentioned with the oil price, there will be some spikes, which when you look at them year on year, are just a correction rate to get back to them where they were. This next graph that we're going to show does look at the actual oil price inflation over the last 12 months. So if you were basing your base inflation figure on the price of oil going back to sort of March of last year, you can see it's really low. And then as the year's gone on and then we've getting through the end of 2020, the vaccine starts to get rolled out and people start using oil again, you can see that the price of oil is now really back at a level just where it was pre-COVID. So that's not massive inflation from 12 months ago. It's more of a correction to get the price back to where it was pre-COVID. And if you look at that figure from there, which would have been sort of past September 19, on the bottom of that chart there, you can see where we've just getting to now at the end of February into March. It's back to those levels, which is obviously a positive thing all around. So we now come to that part of the presentation where we look at how equity markets have performed over various time periods. The first graph that we'll put up shortly will be how equity markets have performed since the beginning of the COVID crash, so to speak, so February 2020 up till now. We'll then look at performances over much longer periods. So the graph you can see now shows how stock markets have performed since February 2020. The FTSE 100 was the graph which we showed all the way through the end of 2020, which was lagging way behind everything else. Then you can see the definite uptick that the FTSE 100 had at the end of November, Brexit and the vaccine, the reasons there. And then from then till now, the FTSE's performed very well. But over 12 months, it's up 5.38%. Had you been invested in the US stock market, you would have seen 27% growth over that period. Another reason why we saw, or you will have seen in some of your portfolios, that there has been a fall in value as you got through to the end of February was, and you can just see the last few weeks of February there, the green line goes down quite a bit there. That was a big sell-off of the technology funds that had done so well during 2020. As we got into 2021, a lot of fund managers thought that those valuations had gotten really high and they took the opportunity to sell them and move into other areas. I was reading an article over the weekend which was talking about recovery stocks, is where a lot of people are now, a lot of fund managers, are now pushing their money into. A recovery stock is going to be a share, if you like, that has underperformed over the last sort of 12, 18 months, where the fund managers think there's going to be some value in there and they can invest in that and we'll get some good returns. But as you can see, that green line did fall. The red line, which is the Msci World Index, which has performed around about 21% since the beginning of the COVID crisis, everything fell there. The FTSE 100, you can see, also fell slightly but has now recovered. So hopefully we're going to see in the coming weeks and months that these funds and markets will continue to grow. This graph that you can now see just showing the equity markets over an exact 12-month period shows much better returns, and this is where you can see how data can be manipulated. So this graph would have been done from the 10th of March 2020 up to the 10th of March 2021. So ignoring the previous 3 weeks from the 10th of March 2020, you miss out a lot of the markets falling with regards to what happened with COVID. We're now getting to that point where we're going to be close to where was the market fall when we look at 12-month data. So anyone who looks at 12-month data and think, oh, that's really good, we've had an excellent year, FTSE's grew by 16%, the MSCI World Index is up 27%. It's not really showing the full picture. Hence the reason that why we now move to the following graph, which is equity markets over 3 years. And this again shows a more sensible picture over the longer term. Had you been invested in the US, you've made almost 49% over 3 years. So really strong period for US market returns. The FTSE 100 over 3 years, very, very poor overall. You've returned 4.98% over 3 years, which is roughly what you would have returned if you'd just been invested since the beginning of the year, probably. The previous 3 years, nothing was made in the FTSE 100. Obviously, the COVID crash caused part of that problem, but the bigger problem was the uncertainties over Brexit, which meant our market was unloved, and some of the share prices in the UK market remain low, while other ones around the world were growing quite fast. And this next graph just follows that up and confirms, if you look at it over a 5-year period, the returns over that period is obviously higher. Anyone who does invest over the longer term will be rewarded for doing so, and it's one of the things that we keep repeating. It's not trying to time the market, it's actually the time that's spent invested in the market. Those longer term investors will appreciate this. Even the worst market that was shown on there, the FTSE 100 over that 5-year period, is growing by 33.68%. So divide that by 5, that's just shy of 7% average growth over that period. Obviously, the US and the global markets have done much better over that period. So we do always recommend that you invest in a balanced portfolio, which gives asset allocation to all of the key markets. The next graph we're going to show is how equity markets performed during the global financial crisis between 2007 and 2009. When we were speaking with a few clients when we were doing their reviews in recent weeks, a few people were getting concerned with the volatility that they've seen in their portfolio since January, and some of the falls that they've noticed when they've been logging in and getting valuations online. Whilst the FCA will tell us that past performance is not a guide for future performance, well, a lot of the times it is really. One of the things we said during 2020 was that the global COVID crisis that was caused saw the markets fall very quickly. 3-4 week period, bang, markets had fallen 25-30%. The biggest financial crash in history up to that point was 2007 to 2009, and as you can see, from 2007, it was around about September 2007 when Robert Peston went on the BBC News and brought it to the attention of everyone in the UK that a financial crisis was going to happen when Northern Rock was about to go bust. It was all the way down to March 2009 before we really saw the bottom of that particular crash. It was a very long drawn out. It was some quite volatile days leading up to it, and then from March 2009, we often mention that it took around about 18 months to get back to being in profit, which was around about November 2010. However, if you look at the red line, the lines towards that after July 2008, you can see that there was still some big falls along the way. I'm not suggesting that we're going to see big falls in the next few weeks and months, but until we get completely past this crisis and over the worst of it, all of the vaccines are being rolled out all over the world. Economies start reopening, no more lockdowns. I see Italy's going to impose another lockdown as we get to Easter. They aren't going to be good for the long term, for the short term markets and the volatility, but over the long term, you will expect this to rise. And as I say, if I think back to 2007-9, you didn't really realise it was over until it was really, really over. So at the moment, we're still going through COVID. There's still going to be news stories that come out and worry people. There's going to be stories about Brexit and such like still going to come out in the press, and the markets fail us. So volatility is still here right now. However, as we keep repeating when we do these updates, we're still very happy with all the portfolios that we recommend clients go into, and we've got no plans to make any major changes to anything right now. So that wraps up another Wealth of Advice update. I hope all of our clients are feeling assured that we are keeping a close eye on things, even with the volatility that's gone on in the last few weeks. We are speaking with fund managers more now than perhaps we have done previously. I've gotten through a lot of client reviews since the first part of this year, so anyone who didn't get a review in 2020 when all the lockdowns were happening and things just weren't happening, we've caught up on all those. We're now working on all the 2021 reviews. Those are getting put in the diary. People will be getting contacted, inviting for reviews. So we believe everything is virtually back to normal. Some of our staff are now coming back to the office a little bit more frequently than they perhaps were, and will continue to do so. And hopefully, as this lockdown does come to an end in April into May, everything will get back to normal as it was beforehand, and we'll never have any lockdowns again in the future. How good would that be? So thanks for listening, and if you need anything from us, just get in touch.